Good evening, everybody. Welcome to tonight's presentation. Really excited about what we're going to be talking about this evening, and wanted to just be very clear with everybody exactly what we're talking about tonight. Kind of a new thing that we're here at Marshall Reddick are doing. It's actually not that new to us, however. So for about the last 10 years, we've been building a private lending program. And tonight's presentation is really all about financing new construction, okay? My pleasure to be with you guys. My name is Patrick Prunty. A lot of familiar faces on the call. Thank you all so much for joining. Some of you that I haven't worked with or that I don't know, I certainly look forward to working with you as we continue to all learn and grow together in our real estate investing career. So again, my name is Patrick Prunty. I am VP of Private Lending here at Marshall Reddick and one of the senior team members. I started back in June of 2003. So if you can all believe it, I'm actually going to be celebrating my 15th year next month. So I don't want to spend too much time on that. We've got a lot of jam-packed information tonight, and so I want to get right into the presentation. I do have one unfortunate bit of news. Our builder, Mr. Paul Beatty, unfortunately will not be able to join us tonight. If we could all have just a quick moment of silence for him. His father passed away on Sunday, and today was actually the funeral. So our hearts and minds go out to Paul. Super good guy. We'll learn a little bit about him, but unfortunately, again, he'll not be a part of the call. Without further ado, let's get started. So just so you guys all know, as I mentioned, really, a lot of people know Marshall Reddick for the buy and hold rental real estate. They don't really even know, as we haven't really promoted it very much, that we actually allow you to invest in mortgages and become the bank, right? No sense in putting your money into the bank. The bank's just lending it out, and they're earning the interest. So marshallreddick.com/mortgages is your gateway and your key to the private lending opportunities that Marshall Reddick offers, right? And like I mentioned, I've got a lot of investors of mine on the call who have already participated in my private lending program, but some haven't. And if you ever need references, most of my folks are more than happy to jump on a quick call or share an email correspondence with you. So please don't hesitate to ask for references. Anyways, as we move forward, I want to talk a little bit of the differences and understand that our lending programs aren't for everyone, okay? But who they are ideal for are those investors who are looking for something that's really passive. Any rental property owner that's on the call tonight, you're going to know if you've owned rental property for a couple of years or a decade or two or more, you understand that it's not as passive as those newbies might think. Okay, but with lending, it is truly passive. It's also very defined. There aren't a lot of variables out there that affect the return like you'd think about with rental property ownership or landlording, as I like to call it. And really, the lending side of the business is 100% a pure cash-oriented investment, right? You don't get the appreciation, you don't get the tax benefits and those other things. This is those investors who come to me and say, hey, I want cash flow, you don't buy a rental property for cash flow, right? You buy it for tax benefits and appreciation and other things. But you lend capital to earn interest, that's income oriented. So if you're that type of investor, this is the type of program that's going to be for you. I also really stand behind our product and what we here as a business do, especially on the lending side of the business, because that's my baby. It's a program that I built over the last 10 years. And it's important for me to share with you why I believe it's very important that you work with Marshall Reddick, but even if you choose not to for some reason, make sure that you work with a reputable team, okay? You don't want to be doing this on your own unless you've got a lot of experience and a lot of connections and a lot of relationships. So a couple bullet points on why it's important to work with Marshall Reddick. Obviously, our education is free. we do a lot of it, whether it's live events or online events just like this. Use us for education, if nothing more. Consistent deal flow. That's a huge one, right? A lot of folks that come to me looking for lending opportunities, they're not new to private lending, but they're leaving their current provider because there's just not enough deal flow. That provider of them, that broker that they're working with, or that investment house that they're working with, doesn't have enough relationships. They don't have a broad enough spectrum in different markets in different states with different borrowers who understand the program and that are loyal to them. We have that. So those folks that have worked with me before, you understand, especially on the short-term lending, as soon as that loan funds, sure, it was great that you earned 10 or 12% interest during that last 4 or 5 months that loan was out, but now you're on the sidelines earning zero. And you need to get back into the game earning interest to keep up that average annual interest rate. So being able to provide consistent deal flow is one of the top reasons to work with Marshall Reddick. Of course, the knowledge and experience and the relationships that we bring to the table, unprecedented. We really have fingers all across the country, and we intend to continue to pursue that as we move forward. Loan structure. This is huge as well. Okay, so we're roughly 1,200, maybe getting close to 1,300 loans that we've funded over the past 9 or 10 years since I've been running this program. We've learned a ton about how to structure the deals, right? And we do that so that we can minimize the risk. As the lender, that's all it is. It's all risk analysis. Is the risk I'm taking by making this loan worth the return that I'm going to get? And what is the probability that this works out as it's supposed to, and I get my principal back plus my interest, right? So risk analysis and the loan structure is key to doing that. And only someone that has the knowledge and experience, have done the number of deals that we have done, can bring that to the table. Lastly, of course, is going to be someone who's available 100% with you and will be able there to earn your trust. So anybody that knows me, right? My program's not flawless. What we've built has some issues from time to time. What I mean by that is, of course, we've had default. That's certainly something that happens in the lending business. But in that 3.5% of the time when that default happens, you know that Patrick and his team at Marshall Reddick are going to be there to provide you with advice and with contacts in the market where your property is located to help secure it, to find a property manager if you need one, sales agents to help you move it, attorneys, whatever it may be to help you stabilize and recapture that collateral that you have on. We can help you with that. And I certainly hope that you'll come back to us if that ever happens. As I mentioned, I fully stand behind our product and believe in the fiduciary responsibility that we have. So now that we've got that out of the way, let's move along. So joining me on the presentation tonight is my senior underwriter. Her name's Stephanie Johnson. I wanted to bring her onto the call.
Thanks, Patrick. It's a pleasure to be on the call. As Patrick mentioned, I'm an underwriter here. All of our deals that we're going to be talking about tonight go through an underwriting process, and I'm a part of that. So I'm really looking forward to further explaining our new construction financing program tonight. And as Patrick mentioned, unfortunately, Paul Beatty couldn't be with us tonight. He's one of our builders in Cape Coral. He's utilized a lot of our financing for a lot of his builds, and we'll be showing some of his builds tonight for reference. Also joining is Craig Puelhorn, one of our VIP Marshall Reddick clients. He's bought numerous properties with us and funded many deals, and we're really excited to have him on the call.
Craig, give us a shout, buddy. You there?
Hey, everybody. How you doing? Yeah, here in a little bit, Patrick's going to be going over, showing a spreadsheet of some of the loans that I've made over the past, I think it's 2 years now. In the money, actually, I've made doing these loans. I've done loans in Indiana, I've done them in Tennessee, and I've done them in different parts of Florida. And, you know, we'll be doing more. Paul, who wasn't able to be here tonight, I actually lent him the money to build the home he's working on right now. So it's a shame that he couldn't be here, but I guess we all understand why he couldn't be. So I'm looking forward to any questions that you may have. And like Patrick said earlier when he introduced himself, if you want to reach out to me at a later time, ask me questions on the side via email or on my cell phone, we can work that out then.
Awesome, Craig. Thanks so much, buddy. I really appreciate you being on the call. We'll get into Craig's background and his history with Marshall Reddick. He certainly is fairly new to our private lending program. I actually think it's 3 years, Bud, but we'll get to that. I could be wrong. I'll have to look at the dates. But yeah, he's one of those kind of old-timer Marshall Reddick clients. He bumped into Marshall Reddick before I did, I think around 2000. Is that right?
Yep, that's correct.
Awesome. Okay, Bud, so we'll circle back to you here in a bit.
We'd like to start with a poll from the audience. We're looking to gauge both our first-timers and experienced private money lenders. So how many of you have done private money lending before?
Yeah, y'all should have the poll on the screen now, so do us a huge favor. Please vote. Feel like it's kind of like The Voice. I don't know if there's any fans out there with that, but you know, we're definitely appreciate response from the crowd. It definitely gives us some insight. We're getting a good, got about 80% voted. We'll give you just a couple more minutes. Let's see if we can get 100% of everybody on the call. Okay, we're going to go ahead and close the poll. Okay, we didn't quite get to 100%. But thank you for your response. So I'm going to go ahead and share the poll. So you should see now on your screen, 30% of those joining us on the call tonight have done some private lending before. So that's fantastic. Okay, so again, those 52% of you that haven't, if you're on the fence for some reason and tonight's presentation doesn't push you over the fence about your next investment opportunity, feel free to ask for some referrals. Would absolutely happy to put you in touch with some other folks. And for those other 10% that are there, yes, note or trust deed investing are kind of some buzzwords that are out there that are revolving around private lending. The difference between the two of those and what I call in our program is that note or trust deed investing is often buying the loan or the stream of income in the secondary market. Whereas a lot of what we do, probably 90–95% of the loans we fund every month, are actually purchase money loans, right? So it's a live closing with a seller and the buyer who's the borrower, and you, the Marshall Reddick client who's lending the money, and Marshall Reddick as the broker, and Stephanie Johnson as the underwriter. So just a little bit of clarity there. So I'm going to go ahead and hide that poll. Thank you guys again for the crowd participation. So as we move on, let's talk a little lending versus landlording, right? Because most folks, when they come to and they want to be real estate investors, the first thing that they think about, of course, is going to be, hey, I'm going to be the landlord, I'm going to own property, and I was just that way, right? When I started in 2003, it's like gangbusters. Everybody was buying property. Marshall Reddick had just an abnormal amount of employees, and it was just like buy. And I bought several properties. Some I wish I hadn't, some I wish I bought more of, but I did learn, okay? And I've learned to myself that one of my original goals was, hey, I'm going to own 10 rental properties, and I'm going to own them free and clear, and that's going to be my retirement, right? And I still have a goal to have several rental properties that I own free and clear, but my strategy has changed drastically. And now instead, I want to have 25 of our long-term loans paying me a monthly dividend every month. And the reason I want that is because I've learned that landlording is not super passive, right? And I always have to worry about tenants, maintenance, and vacancy. So we'll dive into that now. Okay, so on the lending side of things, again, no tenants, no maintenance, no vacancy. We're very defined. Very few variables. Everything is going to be fixed. Your loan term, okay? Tonight we're talking new construction, so we're talking 12 months maximum. Okay, we're talking interest rate is fixed. You know what it's going to be, right? There's just very few variables out there to change your return. Very liquid. Okay, so obviously on the short term, the average turnaround is going to be, you know, in the new construction, we're talking 6 to 9 months because they've got to build it. They've got to get certificate of occupancy after the build construction is done, and then they got to move to market to sell it. Okay, so then we're talking in a hot market, you know, 30 days, you're under contract, another 30 days to close. So you're earning a high yield, and it's very liquid. Some cons to the lending side of the business is there's no appreciation, right? We talked about that a little bit. There's no tax benefits. A lot of times people ask me if there are write-offs or things to shelter the income, and there's not. And there's also no leverage, right? It's more like a stock market play where you can't actually borrow money to do the investing. On the landlording side of the business, of course, it's more active, right? You have to manage your property manager. It's just an absolute must. If you're not watching the store, especially for a California person buying in Indy or in Tennessee or in Florida, I hate to say it, but property managers just know that people in California aren't watching the store, and they will over time take advantage of you if you don't manage them. Property management's like it's worth its weight in gold as far as rental property ownership is concerned. Many variables on the landlording side of the business, right? So values and rents are subject to economic factors. Rent values go up, rents go up, values go down, rents go down. I mean, over time, they're consistently going to go up. There's no doubt about that, but you got to worry about timing. Okay, whereas on the lending side of the business, like I'm lending this amount of money and that's the total amount I'm lending, and I'm going to earn 10 or 12% on that. And really the only variable that could be there is if you run into a default. And in that type of situation, you always have the property as collateral, right? There's always that hard asset that's there. Anyways, moving along, illiquid. When you're going to go into landlording, I mean, that's a 15, 20, 25, or even longer year play. Okay, so very, very long term. Not that that's a bad thing, okay, but just the pros and cons and the differences. As we discussed, different from the lending, there's always potential appreciation or depreciation depending on when you buy. Certainly, my opinion, one of the best benefits to owning rental property is the tax write-offs. Right? And the number one thing really is the ability to be able to use leverage. Everyone's heard the OPM, other people's money. Certainly, if you can borrow cheap bank money and leverage that to a higher return on the landlording side of business, that's one of the super pros. Okay. As we're going to dive in.
So these are some of our private real estate lending programs. They're a little outside of tonight's topic, but we just wanted to share them to make everyone aware of the programs we offer. The new construction is going to be more in the fix and flip program. So as I mentioned, we have two of these. One is going to be the fix and flip, 12 months, as Patrick mentioned, very liquid, and the other is going to be the buy and hold mailbox money. This term is anywhere from 3 to 30 years, and you're going to be receiving a monthly dividend every single month. And so great to stick into your IRAs and know that every month you'll be receiving a monthly dividend. So,
yeah, just to kind of reiterate, we're definitely going to continue on with our new construction as the scope of for tonight, but it's just important that you understand that we do also run these two programs side by side.
Some important facts to know are that on every single loan, there's only one lender. There's no syndications or crowdfunding, so you know that the loan that you invested in is the loan that you're going to be on. Very similar to conventional financing and lending, we have always used title, escrow, and insurance services to further protect the lender, and of course, you're collecting the interest.
Yeah, important just to reiterate on that. Thank you, Stephanie. The one lender on one mortgage, people really like the visibility on the deals. I've had a lot of people come to me from other places where there's a syndication or a mortgage pool that they're investing on, where they lose the visibility on what's being funded. We will have a syndication as well, but you'll never lose visibility because everything we do runs through the website. But nonetheless, as the one lender on the one mortgage, it's your choice. You decide if you want to fund the deal or not. And if you don't, that's okay. And if you do, you know that that's the one you picked, and you picked it based on the underwriting and the data that was available and made available to you through Marshall Reddick or through your own channels.
So here we have each program in a little bit more detail. The fix and flip, you're gonna get a higher return, anywhere from 9 to 12%. They're going to be mainly fix and flippers who are fixing and flipping properties, so very liquid. And most of these loans are going to be balloon payment loans, meaning that all of the principal and accrued interest will be paid when the loan is paid off or when it matures, whatever comes first. And of course, we have that 90-day interest guarantee.
Yeah, you got to understand that we want to show you the new construction is going to be very, very similar. We're going to show that rate sheet on the next slide or one of the next coming slides. It's very similar to this fix and flip program. Okay, but for those IRA or self-directed 401k borrowers out there, understand that if the risk that you see in the short term is a little too much for you, you might consider the buy and hold in the long term, right? And we're happy to talk to you one-on-one about that, but that's just outside the scope of tonight's call. Want to give you a little insight too as to what Marshall Reddick's loan pipeline looks like, right? We're not a huge shop, right? We're not a behemoth. We desire to get there one day when we have the right systems and processes in place. But just a little info. So currently we have 280 loans in play. I mean that's 280 loans that are funded right this second in some stage of construction or in some stage of something. And we have, trust me, loans that are paying off every single day and new loans that are funding every single day. So right this minute, there's 280 that are in play. 170 of those are the short-term new construction type, and 110 of them are like the mailbox money, long-term type buy and hold monthly payment loans. So just a little insight. The total amount of capital lent by Marshall Reddick clients just like yourself across those 280 loans that are out is roughly $26 million. So right about $90,000 average loan size, which makes it very doable for a lot of people. Okay.
Every month, we're funding about 25 to 30 loans, ranging anywhere between $25,000 and $1 million. Every so often, we do have loans that come in the door that are over $1 million. However, with us requiring one lender to be on one loan, these become difficult to fund because not everyone is willing and able to fund a loan of over $1 million. So we turn these down a lot of times. But between all of these loans, 75,000 to 200,000 is the common range that we see. Absolutely, that 75 to 200 is really our wheelhouse. And so again, just to reiterate, we're not a huge shop, but we're happy with the volume at 25 to 30. Again, plenty of deal flow for the investors we have in play. And for those new investors who would like to join and be a part of this program. The new construction that we're talking about tonight, that range is a little bit higher. Usually we're talking a little bit nicer home. And so we're talking maybe $150,000 to $350,000 range. And you'll see that when we dive into a couple of the new construction loans that Craig's recently funded. Here we have our new construction financing loan programs. The first one you'll see offers interest-only payments, meaning every month you'll receive a check for the interest, and at the end of the loan you'll receive your principal back. Our most common program is going to be that middle one, the 10% balloon program. Going to be the same criteria as that 9% interest-only, option. However, you're going to receive all accrued interest and principal at the end of the term. And then, of course, we have that 12% option as well when the borrower is financing the land. The 9 and 10% options, you'll notice, are required for our borrower to own the land free and clear, meaning that he has already purchased and come out of pocket with his own funds to purchase the land, making it a lot safer for the investor.
Yeah, just so everybody knows, this is the rate sheet that a borrower, a new construction borrower, would obtain from Marshall Reddick. So we have at Marshall Reddick established these loan programs as palatable for both the borrower and the lender. It's a good mix. Certainly the lender would want to charge more, and certainly the borrower would want to pay less. But as Stephanie mentioned, really that middle program is the best in my opinion. The borrower likes it because it's no monthly payments required. And those of you who are familiar with my program know that most of the fix and flip deals are no monthly payments. That's a huge value add that Marshall Reddick offers to its sophisticated borrower base. Once in a while, and of late, we've had a lot more monthly interest-only payment loans, which would be that 9%. And we seldomly get the 12% opportunity where the borrower wants to also finance the land. If that's the case, our construction loan would only be 100% max of the construction cost, and the borrower would have to have a second or a lender to subordinate that would be the land lender. So I want to get too detailed with you guys on that, but just understand this is what the borrower would look at. You don't get to choose these. You can certainly say, no, I don't want to do one 12%, or no, I don't want to do, whatever. But this is what's established, and we do this so that there's no negotiation between borrower and lender. These are the programs that we have produced. Everyone knows them. You participate or you don't. Let's talk a little bit. So funny, I get calls now and then, and I was telling Craig a few minutes before we got started on the call about a guy that I had at an event I was teaching up in San Jose that just couldn't wrap his head around why would someone pay interest rates at 9, 10, or 12%. So I wanted to speak to that a little bit. Let's talk and compare, as I love to do that, bank and conventional versus private lending in Marshall Reddick. So on the conventional, on the bank side, it's very hard to find. As a builder, a small builder that is, or a developer, an entrepreneur, there's not a lot of options out there. The banks that are out there that finance new construction, they're looking for the Lennar and the Pulte and the KB Homes and those like national scale builders, that are publicly traded and that type of thing. It's just not, that product's just not out there. Furthermore, it's financially invasive. I mean, literally, they're going to want your firstborn as collateral. And not that that's even the worst. The worst part about it is that the time frame and the slow, how slow the bank is. I mean, Craig, are you there? You want to tell us? I know you've done some new construction yourself, and as the borrower, how long are the banks taking, man?
They take forever. Think about just buying and selling a house now when if you were selling a property or you're trying to buy a property, it takes 45 days to get things closed. Back, quite a few years back, I was building homes on what was called down in Florida construction to perm. And those I went through national banks to do them, you still had to have 25+% down. There were still contingencies for the land had to be prepaid or rolled in. They made draw payments out to the builders and all this other stuff, but it took a boatload of time. Think about applying for a new home loan right now. They want a couple years worth of taxes, bank statements, and all this other stuff. It takes quite a while. And a lot of these guys like Paul, they've got opportunities now sitting in front of them, and they see this as, yeah, I'm going to pay 10%, I'm going to pay 12%, or I'm going to pay whatever number. But I can get this built and done in this period of time, and my profit margin is still, let me throw out a number, $100,000 for them, so they don't care that they're paying you 10% on $250,000 or 12% on $250,000, because they're still going to make their big upside.
Right.
So,
I mean, Makes perfect sense. It's like, look at it as, hey, if I've got opportunity to make money, am I going to not take that opportunity because I'm going to make 50% less or 25% less or even 10% less because I'm paying a higher interest rate? Hey, if I'm still making money, I want to do that deal. It's just the cost of capital. So yeah. Awesome, Craig. Thank you, bud. All right, on the private Marshall Reddick side, we're talking about very relationship-based. So all of my borrowers, I know them very well, okay? We're talking constantly. I've been to all of these markets, right? I've been to church with my borrowers and their families, right? I go to their dinner table. It's that type of relationship, right? I have that a lot with my clients as well, and those of you listening, you know exactly what I'm talking about. Quick and responsive. Absolutely the key here, right? As we talked about on the bank side, right? It doesn't end up being a lot cheaper, and the holding costs that in terms of how long they're taking to get through would eat up, any of that cheaper difference. Okay, so understand that customer service is key, and that's where someone like Stephanie or my team comes into play. Stephanie is assigned to every loan that runs through our channels has an underwriter or an analyst assigned to it, okay? And that is a dedicated person that the borrower and the lender both speak to and handle all correspondence, right? So we pride ourselves on being a very efficiently run business. And then the rates, sure, they're higher, but the dollars actually aren't that much different, and they're not a deal breaker. So let's look at an example. Okay, so if we're talking about, and I picked $250,000 as one of the loans we're going to look at that Craig funded, is actually $250,000. We're going to see photos of that here in a minute. But if the borrower was doing this, and let's say they got an interest at 6.5%, new construction loan, annualize that interest out, that's $16,250, and of course you're going to have monthly payments required. Okay. On the private side of that Marshall Reddick, this exact loan that Craig funded for Paul Beatty, $250,000 loan amount, 10% interest. So we're talking $25,000 annual interest and no monthly payments required. So the interest is still accruing, but there's just not monthly payments being made. Okay, so 9-month average hold for Paul, including getting through everything and getting the property off the books. If we put these side by side over 9 months, the difference between interest from 6.5 to 10% is $6,500. Whoop-de-doo, right? And I had on here, I was going to ask Paul directly if the service and speed that we offer is worth the $6,500. And he would say, absolutely, 100%. I'd rather put it in your lender's pocket than the bank's pocket anyways. So understand that's why someone would borrow at rates like this.
Now we're going to go through our website and finding available mortgages on our website. So in order to do this, you would obviously have to go to marshallreddick.com and hover over the Invest tab, where you would be able to find our properties. So if you're interested in properties, you'd be able to go there, or mortgages, you'd be able to hover over mortgages and click on that. Then we would get to this page. There's listed all of our loans, whether they're available or funding in process. We have some other filters that you can use as well in order to filter these out, in case you want to see a loan that has a payoff request, or that's actually been funded, or actually been paid in full, meaning it went through the entire process and got paid off. You can see all of that through the My Filters tab. And of course, in order to do this, you're going to have to create an account, and you'll be able to, look through our website and see everything that's available.
Also understand, too, the transparency that Marshall Reddick offers. The loans are not just that are available or shown. You'll notice the loan status there on the left-hand side of the screen. Funding in process means I have a commitment from a lender already, and we're in escrow. That deal is going to be funding shortly. And so on and so forth, right? Then they move to funded. And then after they're funded, they move to paid in full. Or once in a while, we need an extension. See, I've got extension down here on the bottom and the left. whatever the status is, even if it was like foreclosure or deed in lieu or anything like that, that would be negative, that would be like one of those defaults I talked about, note that it's full on the website for everyone to see. And as we grow and scale, it's important for us to do that. It's important that everyone know exactly what we're doing. Participate if you'd like. So on the full details, that last red arrow I've got there, when you click on that, when you're in the list view here and you want to get into the details of a particular loan, go ahead and click full details. When you do that, you dive in to the detail view, right? And this is just one portion of that detail view. We give you tons of information, right? We give you all the information that we believe you need to make an educated decision on whether you want to fund the loan or not. One of the cool parts about new construction is what we call funds control. So we certainly don't just fund the loan on a dirt lot and give Paul $250,000 or $350,000 right, on a dirt lot that's worth 50 or 60 grand, right? That would be foolish, no matter how much we trust him. So instead, we do what we call reimbursement style draw schedule. So, and Craig can attest to this. I mean, in this particular loan on the program that we're looking at, when we fund this, the lender will wire in all $315,000. Okay, but 100% of that $315,000 will sit in escrow, safe, not to be released without lender consent. Okay, and we will have Paul do the rough plumbing, pour the slab, do all of those things, and then take draw one to be reimbursed for what he's put out. Then he goes up and he does the second phase, and so on and so forth. So you can see the releases on the screen here and how we piecemeal the loan, even though you as the lender, listen up, earn interest on the full loan amount from day one. That is a fantastic benefit to the new construction lending program. And I think, frankly, it's less risky than some of our fix and flip loans, because you're requiring the builder to put out his own cash first and then reimburse him at certain discussed before milestones. Okay, we also provide you with all the details of who's involved in the transaction. So you can see I've got third-party services here, and we do that again, transparency. Right? If you feel the need to pick up the phone and call the escrow company and make sure that Stephanie's not telling you something that's not true, right, and actually verify that you're getting title insurance, or you want to call the insurance agency and verify that Paul Beatty and Beatty Development has a builder's risk policy in place, hey, we give you that contact information. We encourage you to make a phone call, right? Again, it's all transparent. You will know everything the entire way through the process. And of course, then the dashboard right there on the right, the returns that are offered. So again, you can see this is a 10% interest on this loan. It's a first position. You know, we seldomly dabble in seconds, and we prefer first. No monthly payments. This one actually offers a 6-month interest guarantee. That's a little bit outside the norm. Once in a while, I can negotiate that on a bigger build job or on a bigger fix and flip loan, but the standard is 90 days. And then, of course, when you decide that this loan is for you, you'll want to click the Fund This Loan button. So moving along, looking at some more detail that would be available and teaching you how to utilize the website.
So here we will have photos that you can look through. You'll be able to find renderings and floor plans. Usually the lot will be there, the land. Sometimes you can find a 3D picture of what the property is going to look like there. Underneath, you can find what the build is going to be. This one particularly is going to be a 3-bedroom, 2-bath. You can find the square footage and some other information about the property. And of course, down below, we have the price comparables. So the first couple, in this case, first few, are going to be land comps. So they're going to be comparables to the actual land that, of course, the builder already purchased in this scenario. And then after that, you're going to find comps that are comparable to the property once it's built out. So you'll be able to look through all of this, and of course you can do your own due diligence too, and look around the area, but we provide all of this for you, and this is the reason why we go through a thorough underwriting process on the front end.
Yeah, the comps are extremely important to understand, right? This is going to establish the Marshall Reddick underwriter's opinion in new construction of after construction value. And it's that Marshall Reddick number, that opinion of value of what the property will be worth after it's constructed, that will set the maximum loan amount we're willing to lend. So just like our fix and flip program, the maximum amount we're willing to lend based on the after construction value is 70%. Okay, so for easy numbers, if the after construction value is 100 grand, the maximum we'd be willing to lend is 70,000, and we'd also would have a cap on that of the construction cost. So in that scenario, if the construction cost in those easy numbers was only 60, we would cap our loan at 60, even though the 70% of after construction value was 70,000. All right. Whereas if it was on the other end of the spectrum, and let's say the construction cost was 80,000 with an after construction value of 100,000, we would still cap our maximum loan amount out at 70,000, which would be equal to 70% of that Marshall Reddick determined after construction value, independent of the borrower. And we show you the comps right here on every mortgage listing so that you can decide if you believe our after construction value is accurate. So again, as you move along, understand that these loan opportunities are in high demand. They move very quickly. So when you see something that you want, don't hesitate to click on the website, right? If you want more information, click the request more information. The dedicated underwriter on that particular file is going to get an email when that happens, and they are going to call you most often within the hour, but absolutely within 24 hours, right? And when you click the fund this loan button, all that's going to happen, again, that email is going to come, but you're going to be required to agree to a short disclaimer. And the disclaimer is simply going to say, hey, this is an investment, and Marshall Reddick's not twisting your arm or forcing you to do it, that you're doing it of your own free will, and you understand that there are risks involved. Same kind of thing as you'd find on about any investment website that's out there, okay? So wanted to explain and dive into a little bit about the website there. So unfortunately, Paul is not here. Again, everybody knows why, but very experienced, okay? And he's very proud of building Beatty Development from the ground up. He founded it in 2009 and has built it up. I think they did like 600,000 revenue in their first year, and they're way well into the millions now. He has most of his trades are in-house, right? So he has a staff, I want to say 25 to 30 people that work for him, as opposed to subbing out a lot of the jobs. And that's beneficial too. Getting involved with a lot of subcontractors can sometimes get messy, but Paul has the luxury not to do that. He's a custom home builder, of course, a general contractor as well, but he's starting to get into the spec home business as things are going gangbusters in Cape Coral. Educated in Clemson University and built over 500 homes to date, the whole spectrum included, 1,500 square feet up to 10,000. I'm actually working for a deal for him right now. It's about 5,000. That's going to be a little under 2 million construction costs right on the ocean, super west Cape Coral. So hopefully you'll see that on the website here pretty soon. And again, Paul, our thoughts are with you, bud. Wish you could have been here. Here we're going to be Paul's talking points tonight. Maybe, we'll have to skip over this, but I'm going to have Craig come back onto the call. Craig's heavily involved in the Cape Coral market. So maybe he could speak to a little bit about what he's done there from a rental property purchase standpoint, from a land acquisition standpoint, and from a lending standpoint. Craig, you with us?
Yes, I am. So far I've purchased 4 homes. 2 homes. 2 of them were duplexes and 2 single-family homes in the Cape Coral area. I'm in the process of selling one of those homes right now because, as Patrick mentioned, I have purchased a couple of lots, which I'm going to build duplexes on. I've got one duplex in process right now. I've got another piece of land sitting there ready for me to go on it as soon as I'm ready to go with a builder that does duplexes. And I've also loaned the money to Paul here to build his single-family home that happens to be on a freshwater canal. In a minute, Patrick will show you the spreadsheet that shows that I load $250,000 on this loan. And if you're interested, write down that address, and then afterwards go Google it. Paul's already got it up for sale. I checked it earlier today. And you'll see why it was worth it for him to pay me that 10%, because he's borrowing $250,000 from me, and he's going to sell this thing for well over, close to $400,000 by the time it's all said and done. So there's plenty of margin for him to make in this deal. And that everybody walks away happy.
Yeah, totally. And again, Craig, I wanted to thank you for being on the call. Always a pleasure to speak with you. And, you know, just tell us a little bit about you personally, as I know you're just one of the good old boys. Always love having good conversations about investing and life and family and all of that. So let us know who you are.
Okay, so as it shows up here on the screen, I'm an electrical engineer. I work for a company called Maxim Integrated. It's a semiconductor company. Some of you may have never heard of us, but I'm what they call the field application engineers. I go into the Broadcoms of the world and other customers, Apples or whoever, and help them solve their technical problems using Maxim's products. This is effectively what I do. I've been a real estate investor for over 17 years. I originally found the Marshall Reddick seminars through a personal friend of mine who I work with, and I had wanted to get into real estate investing for a long time. Unfortunately, I'd always try to look at doing it in the state of California, and you know, you look and see you could still buy a house in Cape Coral, Florida for about $180,000. Good luck trying to do that here in San Diego or anywhere in San Jose and that kind of place. It's not going to happen. So I was able to learn how I can go to different states and use the Reddick network to go and leverage their experience to help me buy property. I bought in Virginia Beach. I bought in multiple locations in Florida. I've owned in New Mexico, and I've owned in Virginia Beach. Just a couple of years ago, after I purchased my fourth property in Cape Coral, I think it was Scott Pastello who approached me after I just closed on another duplex at the time. He approached me and he said, "Hey, Craig, we also have this other wing of our company where we do this private equity, private money lending. Would you be interested in that?" And then Scott had hooked me up with Pat on the phone here. So that's how I got to where I'm at today. I went to San Diego State University, go Aztecs. So, you know.
Yeah, that's awesome. And I love to show, I had to clear this with Craig. I wanted to make sure it wasn't too invasive. But on the screen now you guys can see these are the 8 loans that Craig has funded. So it looks like 16, 17. We are in the 3rd year, Craig. So what are we, that first one, or I guess a little bit closer. Oh, yeah, we're in the 3rd. That first one was at the tail end of 15 there.
Yep. And that one, I got one, yeah, shortly after I sold a property and I had cash sitting in the bank, and interest rates in the bank, I mean, your money's doing nothing. And I wasn't interested in putting it into Wall Street because I thought it was rather inflated in 2015. It's even more so now. So that's when I made my first investment as far as doing a money lend.
Yeah. And on the screen here, you can see the 2 that I highlighted here are actually new construction loans Craig funded. The one there on Embers closed and paid out a couple of months ago. And the one that he was talking about that we've described earlier, that $250,000, is the 2150 Southwest 4th Avenue that's currently in play as we speak. So let's, these are kind of Craig's talking points for tonight. He's gone over most of them. Craig, maybe you can just give us a little thought on where you stand today in terms of the lending versus the landlording.
You know, it's funny because you mentioned earlier the benefits of being a landlord and having a depreciable asset. So I still have some of that, but I got to tell you, you're right. You have to manage the property managers. My first property I ever purchased through the Reddick network was in Virginia Beach, Virginia. That's the only property manager I've never fired, Rebecca Ngati. And I've had 3 tenants in 17 years. That's it. The last one's been there for, I think, 13 years or something like that. It's crazy. So
You're lucky.
it's smooth sailing when you have to deal with your property managers. Like Pat said, they know you're out of town. So I actually make it a point where I fly into town every once in a while and I visit with these folks. So it's a lot of work.
Well,
As
on the
opposed,
lending side,
I mean,
on the lending side of things, you get to rely on us, right? You get to rely on myself, Stephanie, April, and Ish. You get to throw the hammer at us.
Yeah, so I got an email from the guy saying, hey, Paul's ready for the next release. Here's the photos of the property, the work he's got done. You could go on Cape Coral's website, looking at the inspection reports, I believe, as well. But they proved to you that he's got the walls up and the roof's on. So according to the contract, the next scheduled draw is due. Craig, do you approve the releasing of the next draw? And it's like Patrick said, all this money's sitting in an escrow account right there, and Paul can't pull any of it until he performs to what he said he was going to do. So that's all good.
Yeah, and you're earning the interest on it the full time.
Yeah, and it's like I said before, Google that property, that address that Patrick flashed up there, and you're going to see he's got plenty of money to make in this deal. And it was an opportunity that he was presented to himself, and he had to do the analysis on his own. Hey, yeah, I could borrow this money. I'm going to pay Craig or somebody, so many thousands of dollars to do it, but look at the upside for me. So.
Yeah, so I've got it on the screen now, so you guys will be able to grab it. Also, as far as the presentation goes tonight, we're always happy to send the PowerPoint slides, so feel free to send us an email if you'd like that. But this loan is funded, so I wanted to point back to the status there, and this is the one that Craig actually funded, and we're here at about release 5, I think, is due next. And I pulled some photos that were taken just yesterday by Paul's project manager, so you'll be able to see the status. And I don't even think, Craig, I don't even think that you've seen these. These are brand new for you.
No, I haven't seen these ones, no.
Yeah, so rough electric, all the rough and mechanicals in. You can see the doors and the casing, the trim are up, the windows are all in. They're getting real close to being finished here. And I think as Craig mentioned earlier on today, Cape Coral is pretty cool. It's got a lot of canals, and you can see that this is on a freshwater canal in the back right there. I mean, brand new seawall, or you can get on this and take your boat out, cruise around. So properties like this, custom built, these go for a premium. So I imagine when Paul gets back on his horse, we're going to get that draw request. And at that point in time, we'll obviously go through the protocol that we're going to discuss here shortly, and make sure that everybody understands exactly how that works so you're more comfortable with our new construction lending. Okay, let's talk loan structure. And I'm going to use this actual, we're going to dissect the deal that Craig funded, right? So the land was owned by the borrower free and clear. Paul Beatty was the borrower, right? And our analysis on this showed that that land, that canal, freshwater canal front lot, unimproved, was worth $35,000, right? So consider that his equity into the deal. Consider that Paul's like gift to the loan process to make you feel really good about it. Okay, $250,000 loan amount was funded January 2nd. Of course, lender's title insurance in place to protect you. Builder's risk insurance policy in place as well, right? Something goes wrong, we're covered. The mortgage obviously is a security instrument that places a lien on the title of the property. We're going to make sure that that's recorded. And then, of course, your loan documents. Marshall Reddick will always receive the original loan documents. We'll aggregate them, meaning we'll gather them, make sure that we have a full collateral file, and we will ship them to you direct once we have that full collateral file. You'll want to hold on to those throughout the term of the loan. At closing, as we mentioned, 100% of the loan amount was held in escrow, okay? And interest accrues from day one on the full loan amount. Huge value add there, you guys. That is, I got to tell you, just one of the most important things. Now, let's talk about the construction part of this, right? So as a part of the loan documents that are signed on the front end, the borrower will sign, the lender will sign, and the escrow agent will sign a construction escrow agreement. And it basically says, hey, nobody can touch this money without written consent of the lender. Okay? Plain and simple. So Paul's going to do what he said he's going to do, or whoever my builder is, or my entrepreneur is that's building this new construction. They're going to do it. They're going to put their funds up, and they're going to come to us in a formal, established manner to ask us for the draws at a set schedule that we approved prior to funding the loan. That way there's absolutely no ambiguity. And that leads us right into our next, defined draw schedules. Okay, we at Marshall Reddick put all of this in place as a protection as we've learned to structure these deals professionally and safely. Okay, so again, no ambiguity. So this was actually the draw schedule that Paul and Craig and myself approved prior to wiring in the $250,000 construction loan. Okay, so draw one, right? Paul's going to have his permits 100% done, signed, ready to go with the county or the municipality over there that is in charge of governing those permits. He's going to have the rough plumbing in, tapped in. He's going to have the slab poured. When that happens, Craig, what happened?
I get an email saying that, do you want to approve the release of these funds? Basically, I sign, I get the proof that the work has been done, and then I sign a document that says, go ahead and release the funds. And it gets sent to escrow.
Absolutely. And then it gives me an excuse to give you a call, right? We chit chat about what's going on and what's good, right? And then I have you send an email back to approve and put into writing your agreement to release that $50,000 draw one. Paul gets that money and he's off to the races for number two. So on and so forth. Okay, so that's what I meant by define a draw schedule prior to closing with no ambiguity. And then lastly, Marshall Reddick oversight and servicing. All of our short-term loans are serviced by Marshall Reddick. Anytime you have a question, you call us. And we're there with you 100% of the way, funding until payoff. So want to be cognizant of everybody's time. And so we're going to dive in and look at a couple new construction loans that are available right now. You can get these on the website. Let's brush up on our geography. So Cape Coral, talking Southwest Florida, and it's in Lee County. So Lee County is highlighted there in red on our Google map. This particular loan is a cost plus build job. So Paul has the end buyer already, and he is building this home for them, and he is in charge of the financing. So he's come to us, right? The land is owned free and clear, and he needs a $315,000 loan to build this home. Now let's dive into that a little bit more. Again, $315,000 loan amount, current land value, $60,000. There's comps on the website to support that value. Actual construction budget's $360,000, but Paul only needs $315,000 to get it done. He's going to put a little bit of his own money into the deal. And it's about a 5-month timeline, okay? Stephanie was the underwriter on this one, and her opinion of the after construction value was $475,000. And I can tell you that that's conservative. All right, I built this program from scratch. All underwriters train under me, and I teach them to be as conservative as possible, right? As much as I love Paul, as much as I love my borrowers, none of this works without the lender. And I would much rather have them, the borrower, come in with a little bit more money and make us on the lender side a little bit more secure. So you're always going to find that our after construction or after repair value will be conservative, right? So $475,000 for this custom home, 3-bed, 2-bath, 2,200 square feet. And I think there's actually a typo there. It's going to be a 3-car garage, not a 2-car garage. Since the land's owned free and clear, this falls into our 10% balloon payment program. And on this, again, we've got a 6-month interest guarantee, right? So regardless of how quickly Paul gets this built and sold, if he did it in less than 6 months, you would still earn 6 months worth of interest. If it goes beyond 6 months, you continue to earn interest every single day. You just have the the luxury of knowing that you have a 6-month interest guarantee if you decide that this loan would be the right loan for you to invest in. Let's talk about another market, right? There was a slide in between Paul and Craig's slides that said that we lend currently in the states of Florida, Georgia, and Texas. So this is Granbury, Texas, so a suburb southwest of Fort Worth. And I got to tell you, Dallas and Fort Worth is going gangbusters too. It's just expanding like crazy. And so this actually isn't that far. And Granbury is it's a really nice lake community, nice historical area, and it's really up and coming. So I've got some developers there that are out of Fort Worth who have identified this area. We're going to be doing somewhere in the neighborhood of 6 to 8 new construction jobs. I have one of them available to present tonight. Okay, so this will be a little bit lower on the investment scale, right? So we're talking about here $140,000 loan. Again, they own the land free and clear, or they will. They don't own it yet. It's a live purchase. It's going to close next Monday, the 21st. And of course, again, we're going to escrow 100% of the money. I can't say that enough, that this reimbursement style draw just adds so much safety to the loan. So if we dive into this one, get $140,000 loan amount. Land's pretty cheap out there, so about a $15,000 current land value. You'll find comps on the website to support that. We've got a a construction budget, 140, and another 5-month timeline, right? They might get it done a little bit quicker than that, but they might sit on it for a month while they're getting their permits and everything dialed in with the municipality that that governs that. $210,000 Marshall Reddick after construction value, and we're another nice standard home, 3-bed, 2-bath, 800 square feet, and of course the 10% with a balloon. This one with our standard 3-year interest guarantee. We're going to wrap it up here. A lot of data. We're getting close to our deadline. The recording will be available. However, if you want to share this with friends and family, we're happy to email you that tomorrow. But we're going to get into some frequently asked questions.
One of our first frequently asked questions is one that we get quite often. It's, as a lender, what costs and fees should I expect? Well, actually, as the lender, there are no fees associated with funding our loans and being the lender. The lender will only incur whatever fee their bank charges them to wire out funds, which is usually around $30. And they'll also incur a notary fee. This notary fee will be on the back end of the loan once it's paid off. You'll have to sign a release of lien, which basically is, showing the county recorder's office that you've gotten paid back in full and that you're effectively releasing that lien from that property. So beside these two administrative costs, there's nothing that would incur for the lender.
Yeah, I mean, there's no cost to you guys as the lender to participate in our program, which segues, right into our second frequently asked question we get all the time, right? What's in it for Marshall Reddick, right? We're in business to make money. Every business is in business to make money. So Marshall Reddick functions just like any loan officer would. Anybody that's borrowed money from a bank or from anywhere knows that you work with a loan officer and you as the borrower pay a loan fee, right? So no different. The lender doesn't pay that loan fee, the borrower does, right? So Paul or whoever, my developer or my fix and flip or my buy and hold guy who's borrowing money through Marshall Reddick's programs will pay us, and that's how Marshall Reddick makes money in this program, right? We make 2 points on our short-term and new construction, and a point equals 1% of the loan amount, okay? So a $200,000 loan amount equates to a $4,000 loan fee that Marshall Reddick would earn. And that allows us not to arbitrage the interest rate. So the interest rate that's on the loan documentation that you as the lender will be on, you earn 100% of the interest, okay? Marshall Reddick makes the loan fee, the lender earns the interest. Also want to dive in and talk, we've hit on this, but how are the construction draws approved and released from escrow? We've gone over that, but let's get a little more detailed. So step one, builder's done what they need to do, right? So let's say in the case that one that Craig had funded, the rough plumbing's in, the permits are all approved, and the foundation's down, right? So then Paul has to go to the city of Cape Coral and get an inspector out there to pass that municipal inspection point. So that's already happened, and you as the lender don't know anything yet. I don't even know anything yet. That happens, and he provides evidence to us that that's happened. And as Craig said, you can actually look this up right online. Technology is amazing today. Second step is that Marshall Reddick, so the underwriter assigned to this file that you already have a relationship with as the lender, because you talked to them on the front end before you decided to fund this loan, and then you communicated with that underwriter and that analyst throughout the funding process until you actually wired the money to escrow. They'll receive a formal draw request from the builder who is the borrower, okay? That formal draw request includes evidence that the inspection to get to that point was passed, current progress photos, very similar to the ones we just showed on Craig's deal, lien waivers, notarized when applicable, right? If they're using subcontractors or people drop off materials or whatever the deal is, that subcontractor is going to have to file a notice, right? And then we're going to get a lien waiver to make sure that that subcontractor was paid, or in the case when Paul is using his own in-house guys, Paul and his business will sign that lien waiver. We're also going to understand what percentage the loan or the project is complete at each draw phase, kind of understand if it's on target, if he's behind schedule, that type of thing. And then, of course, the target completion date, so we can kind of understand if we're still on schedule and how that's all going to work. So at each draw request, we're going to get this detail. You, again, will not approve the draw unless you're comfortable with it. But anyways, after the dedicated Marshall Reddick analyst approves of this information, then they're going to contact you as the lender, right? So, and we talked about with Craig before, he just gets an email and a phone call, right, after we've gone through steps 1 and 2. And if we don't like what we see on steps 1 and 2, we kick it back. And that happens from time to time. We're not interested in wasting your time, and we're not interested in wasting our time, right? So there's no sense in, if we're not comfortable with approving that draw, that we should put it to you for you to approve that draw. You're not in the real estate industry. We are. And then, of course, again, the escrow agreement specifically states that no funds shall be released from escrow without written lender approval. So you will always provide that approval. And my written email form is completely fine, right? As long as you put in writing, yes, I approve draw 3 in the amount of $50,000, the escrow holder will be A-okay with that, and they will proceed to wire the draw to the borrower. Okay, so that's how the construction draws are approved and released from escrow. Now, I'm not going to spend too much time on this one because we hammered it out throughout, but defined was talked about earlier. I get that a lot. Again, on the lending side of the business, there are very few variables. It's mostly fixed, it's in play, it's liquid. You're not going to have variables changing the situation. Okay, so that's what I mean by defined. Also, you know, kind of as we dive through that, let's talk about Craig's loan, not the one that we've been mentioning, but let's talk about the one that closed out before he funded this one on Southwest First. So this was the one on Embers.
Yes, so let's use this one as an example. As Patrick mentioned, it was funded and it's completely closed out. So we're going to show you a little bit of the numbers. It was funded on July 7th of last year. The loan amount was $150,000, 12% annual interest, $50 per diem interest, meaning $50 per day is what he's earning. You can calculate that by multiplying the loan amount by the interest rate, and we divide it by 360 days in the banker's year rather than a regular fiscal year. And it was repaid on February 27th, which would translate into $11,750 of interest earned, which would be a grand total of turning his $150,000 into a $161,750 return.
Hey, Craig, not a bad day's work, huh?
Not a bad day's work. Just imagine what that return wouldn't have been if I left that money sitting in the bank. That probably would have been about 100.
I love that, right? I mean, it's just, you obviously have to have capital in this program to be able to invest. But we have loan amounts of all shapes and sizes, right? And again, no ambiguity or outside factors affecting this return. All right, very important. Let's talk about if we catch a default, right? It does happen. I mentioned earlier about 3.5% of the time. So we've got somewhere in the neighborhood of 40, 45 defaults. And just because I say default, you know, a lot of people are very much like gun shy, or they think, hey, that means I lost everything. And that's just absolutely not the case, right? So just because you have a default just means that the maturity date came and went and the loan hadn't been repaid. Maybe we give them a short extension. Maybe they just pay off the loan in full, and maybe not. Maybe the construction went completely sideways and maturity came and went, and maybe we have to actually foreclose or take the property. That's the worst case scenario, right? But certainly we're going to know well in advance if there's a problem, and especially in the new construction, we're not going to be approving draws if things aren't getting done. Right, so really in the new construction, the worst case scenario is we get a break in the economic cycle, right, and we get a little downturn. And maybe Paul's got this property that he built and he's having a hard time selling it. He's reducing the cost. At the end of the day, you as the lender are safe, right? And that deal that we talked about for Craig, that was $250,000 loan amount. If you've gone and Googled that, you see it's listed for like 400. All right, so he's got plenty of equity there, and in the worst case scenario, like ultimate economic meltdown, what's going to happen? You as the lender are going to end up with that property for a $250,000 investment. Pretty damn good position to be in, right? So just because we have a default doesn't mean it's all bad. It just means we have to do some work. And again, Marshall Reddick, my team, and the resources that I have will be with you 100% of the way if that happens to you, okay? Doesn't happen often. It does happen. Important for you to know. So we're going to do one last quick poll as we wrap this up. So I'm going to go ahead and share it now.
Which new construction loan sounds most appealing? The one in Cape Coral that we showed, the Granbury one that we showed, or neither, because you prefer to be the landlord and not the lender?
Had to have a little comedy in tonight's presentation, and we all take ourselves too seriously, and we all work too hard to not get a chuckle every once in a while. But certainly would appreciate it if everyone, as we wrap up here, I know we're a little over time, but we're just about here to the end, and if you could get your votes in, we greatly appreciate it. Always love that feedback. Craig, what's your vote, buddy?
I've been heavy in Cape Coral. I go with Paul again. He's performed to what he said he was going to do on time.
Okay.
So I'd take that one.
That's awesome. Yeah, a little bit higher. I was assuming we might get some more votes for the Granbury because it was a little more palatable at 140,000, but you never know. But we're going to go ahead and close the poll. Get your vote in if you haven't voted. All right, and we're closed. So let's go ahead and publish those results.
So it looks like 63% of you prefer the Granbury, 31% Cape Coral, and sadly 6% prefer to be the landlord and not the lender.
I don't know, sadly. It might be sadly for our program, but hey, everyone's entitled to their own opinion. But again, thank you guys so much for the vote and the participation. Okay, so everyone has questions, I'm sure. I know there's a lot more coming in. We're over time, so we're going to wrap up the webinar. Our contact information on the screen is available. Send us an email, send us a phone call, or if you're local, please come to the office, right? I got this beautiful new conference table, and I'd love to sit across from you and talk shop. Stephanie, you the same?
Yep, I am. I enjoyed being on this call, and we're looking forward to the potential of working with everyone.
Awesome. And Craig, thank you again, buddy. You got any final thoughts?
Good luck to everybody out there. Hopefully you make a move and you start with the $140,000 one. I started with something like 85. I can't remember what the exact number was. But go ahead and start small. Doesn't hurt to start small.
Yeah.
See how it works.
Great.
Figure it out. Learn something.
Yeah, and I promise, Craig, that when I get 15 emails tomorrow, all looking for your phone number, that I won't give them all at one time, okay?
All right.
All right, y'all. Thank you again for joining us. You have a wonderful evening, and we look forward to speaking with you.
All right.
Bye-bye.
Thanks, Pat.